Welcome back to another edition of Level Up Life Money Hacks. Today we're going to have a conversation about a concept that people may have heard of, but most likely they never heard of. The concept of your life insurance as a bank. So, to kind of touch on it, right? The first thing that you have to understand, and this is not financial advice, this is educational and informational. All right. So you can only borrow against a permanent life insurance policy, such as a whole life insurance policy, a universal life insurance policy, or a variable universal life insurance policy. The average person that has some kind of half baked life insurance policy is going to have a term life insurance policy, which is through your job. You know what I'm saying? Like I got a term life insurance policy. As crazy as that sound, right? Um, so that type of policy doesn't build cash value, so you can't borrow against it. So now that that's out the way, we understand what you can borrow against and what you can borrow. The term life insurance policy is pretty much like the generic through your job, you cannot borrow against it. So now that we go to step two. Once you do, or if you already have an existing whole universal or variable universal life insurance policy already existing, you want to have some kind of cash built up in those accounts. So your cash value is like a savings component inside your policy. It grows over time as you pay the premiums. And the insurer, they invest a portion of that money. So typically it'll take 2 to 5 years before you have enough to borrow against. So you could check your current cash value by logging into your insurer's portal, calling the insurance agent or company, and then reviewing your annual policy statement. Once you get to a point where you've built up a decent, you know, amount, you can request a policy loan. So you can borrow up to 90% of that amount. The exact amount will depend on the insurer. And so, steps that you can take, you want to contact the insurer or agent. You want to fill out a loan request form, which can be done online with many companies. You'll review the interest rate and repayment terms. And then at that point, once you've completed the application process, you'll get the funds, which will usually come either by check or direct deposit. So, the next part of the operation, you need to understand the interest and the repayment. So, you'll pay interest on the borrowed, I don't know where that accent was trying to come from, borrowed, on the borrowed amount. You typically want to pay 5 to 8% annually, which is good because if you was to take out that same loan from your traditional bank, you might be paying 10 to 18% or something crazy like that. You know what I mean? So you're borrowing from your own policy. The insurer charges interest because the cash value is used as collateral. You can repay on your own schedule, but if you don't, the loan balance will grow with interest. Your death benefit will be reduced by the unpaid amount. So if the loan grows too large, the policy could lapse. Cancel basically, triggering a tax bill, which you don't want. So these are important things to keep in mind. You want to reduce payout. No, forgive me. Let me run that back. Important things to keep in mind. If you don't pay that loan down or pay it all the way off, when you pass, your beneficiaries will receive a reduced payout amount. The policy could lapse, as I mentioned just a second ago, if unpaid interest piles up. You may have to deal with possible tax issues if the policy lapses with an outstanding loan. And having no fixed repayment schedule can be seen as a pro or a con. So you must have discipline if you were to consider taking out a loan on your insurance policy. So I just had to get all of that out there, right? So an example, you have $50,000 in your life insurance policy. You decide to take out a loan for 30,000. The interest rate is only 6%. So if you don't repay, your death benefit that your loved ones would receive would be 30, it would be 30,000 less, so it would be 20,000 plus whatever accumulated interest. You get what I'm saying? So if you do repay, the death benefit remains intact and you regain access to that cash for a later transaction down the line. So you could kind of even think of it almost like a HELOC, but way better. Um, so additional things to think about when it can be smart to borrow, right? You know, if there was a medical emergency, or maybe there's home repairs that need to be, done, or if you're trying to pay off some other debt that has a higher interest percentage, a credit card that got 27.99 interest percent, you need to get that off your back ASAP. This could be an alternative to fix that type of situation. Um, or if you just want to have additional money to supplement your retirement income. So, all right, moving on. Only borrow what you need. These are just pro tips. Make at least interest only payments to avoid compounding your debt. You want to keep track of the loan versus death benefit balance regularly. And then the bottom line, borrowing against your life insurance can be a powerful, low hassle way to access cash, but it's going to require careful management to avoid reducing your coverage or triggering taxes. So, for more information or questions, feel free, leave a comment, and maybe we'll do a follow-up video. As always, I appreciate you guys tuning in to listen. Like, subscribe, share. We have 140 subscribers at the moment. The sooner we get to 500, the sooner we can go crazy and go to that next level. So have a great one, and until next time.